Okay, welcome back to capitalforextraining.com. In this video, we're going to be discussing a continuation strategy called the 10 EMA bounce, or the 10 exponential moving average bounce. So what you need to do is just to load up a few indicators, and I'll explain throughout the video exactly how we trade it. Now, the first thing you need to do is load up the Bollinger Band indicator. Make sure you set the period to 20. Then you need a 10-period exponential moving average. Then you also need RSI, which will usually be plotted at the bottom of the screen. That's the relative strength index, and make sure the period for that is 10. And you will also need the momentum indicator, which is only available, as far as I know, on MT4, MT5 platforms, and the period you need for that is 14. When you do get the momentum indicator, can you just make sure that you draw and confirm a line, just a horizontal line like this on the indicator. Make sure it's at 100 and just double click it in order for it to stay, and then you're ready to go. Now, don't worry if you haven't got the momentum indicator. This is just a confirmation indicator for MT4 and MT5, but you can also use stochastics if you need, and they're all used in the same manner. So, but to be honest, if you haven't got it, I wouldn't really worry too much. So the aim of this strategy is to place a trade that follows the current trend, and the way that you enter that trade is looking at the place, or identifying a place where the market bounces off the 10 EMA, the 10-period exponential moving average. And you can see that the market has done that just here, okay, in this little area. So you've got a candle here that was actually started off being a big long white candle, and then the market just cruised in the downwards direction. So I'll tell you exactly how we trade that. We actually trade this one quite a lot, and it's very easy, so you shouldn't have any difficulty in picking it up. But if you do get stuck, watch the video again, etc. You will be able to trade this. It's very easy. So I'm just going to zoom in a little bit. So what we've got here is a 10-period moving. Is a candle that hits the 10-period moving average. Okay. Now I'm just going to draw a line so that we can find ourselves as we funnel down. Now what we then need to do is just to check the M30. I'm going to zoom out a little bit. The M30 and the M15 indicator, just to see if there's anything drastic going on in the trade. Don't worry about any indicators yet. All you're looking for is basically an answer to, is there some kind of a hint that the trend is actually moving in the upwards direction now? Because in the H1, remember, you're going downwards, and that's what we started off with the 1 hourly chart frame. So we got a downtrend in the hourly time frame. M30 still got the downtrend prior to this line. M15, yes, we still got a downtrend going down prior to this line. So then we start looking into the 5-minute time frame, and this is where it becomes a little bit more serious. So what you're looking for is two things. You're looking for the M5, the 5-minute time frame, the candles within that time frame to start touching the upper Bollinger Band. Okay, so what you're effectively looking for is for a bounce off that top Bollinger Band. Now, even though you're looking for a bounce in the hourly time frame of the 10-period EMA, in the M5 period, and in the 5-minute chart, you're looking for a bounce off the top Bollinger Band. Okay, that's exactly what we got here, and you can see that the first candle that's touched that top Bollinger Band is this white one here. Okay, this candle here. So I'm just going to move that line there. Now, what you're also looking for is for the RSI to be oversold. Okay, sorry, overbought in this matter. The reading for that is 70. Okay, that's quite standard. If you don't know this, have a look at our RSI videos. But in general terms, once the RSI reading is over 70, that it suggests that that particular market is oversold, and that's exactly what we've got here. We've got candles 1, 2, 3, 4 candles touching, 5 candles touching the Bollinger Band, and you can see that if I just hover over this, our reading is 71.17 for RSI, okay, and it's 70.51 there, so it's over 70, so that's good to go. Okay, so that's the first candle that touches the top Bollinger Band, so just put a line on that candle. Now you're looking to funnel down into the 1-minute chart frame. 1 minute time frame, and this is the time frame that you use for your entry. Okay, this is the time frame. So we've got our line here that we marked in the 5 minute time frame. Now what you're looking for is for divergence in the RSI. Don't worry about whether it's oversold or not. It's oversold in the 5 minute time frame, so that's down, that's done. Now after that point, not prior to it, after that point, what you're looking for is divergence in RSI, and you can see and I'll explain to you what I mean by that. Again, if you don't know what this is, have a look at our RSI video that we've done before. But in this particular example, what we're looking for are these higher highs here. So we've got a higher high there, and we've got a higher high there, and we also actually got a higher high there. It's not quite touching a line, but it doesn't matter. Now, if we line those up, okay, you can see that we've got divergence forming here, and by that we've got higher highs obviously going in the upwards direction in our price chart, but we also got lower highs going downwards in the RSI, okay, and that's divergence. You line these up and you will easily be able to spot the divergence, but make sure that it's after. Remember when we marked this in the M5, okay, here, make sure that it's after the first candle that touched the top Bollinger Band in M5, not before. If it's before, it doesn't count, okay, it needs to be after the M5. So the M5 line that we drew, which is this long one here. Now when we're looking obviously at that line in the 1 minute time frame, we're looking for this divergence. So after that divergence, all we do is connect the higher lows as well. So you've got two trend lines at the moment, pretty much making some kind of a shape here, not quite a triangle. It doesn't matter, it can be as many higher lows as it wants to make. It can be as many highs as the market wants to make. It will never really be the same, but the idea is that you get this divergence. Very important. Now what you're also looking for is this Bollinger Band squeeze. Okay, now you can see how the bottom Bollinger Band is coming up here and the top Bollinger Band is starting to come down. That's called a squeeze, the Bollinger Band squeeze. And the Bollinger Band squeeze is always followed by an expansion, okay? So if this was a very big opening, let's say this bottom Bollinger Band was down here, this wouldn't count. You'll have to wait for more of a squeeze. If the market goes in the downwards directions and the squeeze doesn't happen, well, tough, you've missed that trade. It's not that's not the type of trade that we're teaching you here. It has to have a squeeze that you can see here, and you know when the expansion takes place is once that bottom trend line is broken. Okay, very important this, so pay attention. This bottom line here is broken once a candle closes under it, okay, not breaks but actually closes under it, and the bottom Bollinger Band expands in the downwards direction, the top Bollinger Band expands in the upper direction, i.e. they expand away from each other. Because if I go to the screen, you can see that that's exactly what's happened. You see that Bollinger Band? You can see that little curl. Whilst you might think this is a very small characteristic, this simple thing here, that simple change of direction of the Bollinger Band will make a difference between you losing and winning that trade, okay? Or even if you're in it, you will only win very small amount of money if it doesn't happen. But once you get this expansion, that's the key. So basically your point of entry would have been on that candle there, okay? And I'm just going to mark up the actual level of entry that's there. So if we go back to the H1 chart, we can see, in fact, if we just get rid of all the other lines, one there and that one, look how high we've entered that trade. Okay, so our stop loss is just a few pips above that. Okay, so you just go into the M1 chart really to mark that up. Where are we? Okay, oops. Yeah, okay, so we just say about what, 5 pips above, okay, about 6 pips above. So that's your stop loss, okay, in the H1 chart. When you look at that, when you reference that in the H1 chart, you will see what massive trading opportunity this offers, and your profit literally is 138 pips, because your target, your first initial target, is this swing low here. Okay, your second target is this the bottom Bollinger Band. Okay, but it doesn't matter whether you trade that target or that target. The actual risk to reward ratio is so big that even if you're wrong and you lose, because of the frequency of these trades, you will be able to, even if you get 2 out of 3, you will still be in a winning position. So obviously try to eliminate making mistakes and try to get 3 out of 3 at a time. But I just wanted to let you know about this trade, because it's very simple to trade once you funnel down to different time frames and mark everything up correctly. And obviously you use the M1 time frame. Look for that squeeze, look for that close under the bottom trend line, look for the divergence between the price and the RSI using the highs of the market price, and you should have no problem placing this trade. And the last thing, kind of as we mentioned, the momentum indicator. This is just something that we kind of use as a preference. Really, you don't really need to use it yourself if you haven't got it, but it's always good to have a reading. So where's our entry candle? So our entry candle was here. So it's always good to have a reading below 100. Okay, so if the reading is below 100, you're looking into a downtrend. If the reading is above 100, you're looking into an uptrend. Okay, but this is just the final piece of the puzzle. Really, it's not 100% important, but if you do have it, we would recommend that you use it. But if you don't, you quite happily you can use stochastics and look for the break of stochastics higher lows. So that concludes this strategy. We'll see you for the next one. Thank you.